Hello, all. This is Started Accountant Omkar Gargar. So, friends, 2026 Finance Bill has been tabled today on 1st of February 2026 by our Honorable Finance Minister. Under the Goods and Services Tax laws, we are here to analyze the amendments which have been proposed. Although there are no much amendments in number, to be very honest, it's being just limited to 5 or 6. Of course, it has a precedence and a reason that just in September 2025, we had the GST 2.0 announcement made by the GST Council, 50th GST Council meeting, and therefore it was very much anticipated that this year on in the budget 2026 we will have a very limited number of amendments. A few of them only to discuss, but one or two of them, of course, are continuing from the discussions that were already happened in the 56th council meeting, and to give an effect to that, there are these amendments which have been now proposed by this Finance Bill 2026. So, friends, let us try to analyze the first one, the proposed provision insertion under 15 subsection 3 clause B. 15 subsection 3 provision deals with the permissible reductions from the taxable value. The taxable value is allowed to be reduced by way of by an amount of discount. Now, discount can be categorically into two parts. One is discounts which are given before or at the time of supply. The second is discounts which are given after the supply. Now, what is the current provision existing as on today? That where the discounts have been given after the supply has been effected, then such discount is in accordance with an agreement entered into at or before the time of supply and specifically linked to a relevant invoice. Of course, along with the condition that it should be reversed, the input tax credit should be reversed by the recipient when the credit note is issued to him. Friends, this particular compliance definitely was calling in for a lot of practical challenges. To regulate it to a certain extent, what the proposed provision now says is that the 15.3b clause will now be read as that the discounts which are after the supply has been effected will be allowed or will be allowed to be reduced if for such discount a credit note has been issued as per section 34 and the input tax credit attributable to such discount is reversed by the recipient of supply in accordance with the provisions of section 34. Friends, till now, under the provision of section 34, there was no explicit provision to issue a credit note for passing on of discount. So if you see conventionally under section 34, there were few scenarios covered, or rather there were defined number of scenarios covered when the credit note could be issued. So where the credit note was allowed to be issued for supply of goods or services where the value charged was in the invoice was found to be more than the actual transaction value, or where the quantity was deficient, or where there was a return of goods, but there was no explicit provision to envisage a scenario that if a post supply discount is to be given, then the credit note can be issued. Well, now what is the proposed amendment? That section 34 specifically will cover issuance of a credit note in case where there is a credit note issued on account of 15 subsection 3 clause B, that is where the post supply discount is required to be passed on, and a credit note can be issued for such purpose. Of course, the recipient is also supposed to reverse his input tax credit correspondingly. Friends, whereas this taxable discount, the taxable reduction in value, of course, is coupled with the provision amendment in section 34. One more question that still remains as a part of litigation and which continues to remain so looks like that where there are non-tax based reductions happening by way of discount, where there are commercial credit notes being issued, what would be the fate of such cases is yet to be decided. The next amendment is proposed in the provision of section 54 subsection 3, that is the provision for refunds on a provisional basis. For currently, what the scenario is that a proper officer is allowed to issue refund on a provisional basis for zero rated supply of goods or services by a registered person or any other notified category of refunds, where a provisional refund means up to 90% of the value, the 90% of the refund amount applied for can be given before closure of the entire refund assessment. That is what is permitted currently. The proposed provision also covers that the not only zero rated supply but also the refunds under the inverted duty structure will now be eligible for the provisional refund by the learned tax authority. Of course, this is going to be a welcome move. The people who are the taxpayers who are having the inverted duty structures are anyway struggling through the aspect of the blockage of funds because of the inverted duty structures. If they are entitled to get, or they are permitted to take this provisional refunds, they will not be required to wait up to the completion of the refund assessment for getting their money encashed and by way of this provisional refund. Definitely the trader is going to be welcoming this part of move. Under 54 subsection 14, currently there is a limitation in claiming refund if the refund amount is less than rupees 1000. Friends, if the proposed provision is to be taken into consideration, what it says, if the supply of goods with payment of IGST has a refund amount up to rupees 1000 as well, that will be permitted under the proposed provisions without any bar on the amount. So the individual exporters who are exporting goods through post or courier, etc., they will be definitely entitled for this kind of refund, and they will be definitely benefited by this kind of refunds. So of course this is going to be a welcoming move for those type of taxpayers. The next provision where has an amendment, of course, carried along from the 56 GST Council meeting. The intermediary service providers. Now the intermediary scope has already been clarified by a circular back in 2021. So intermediary is nobody but a person who facilitates a transaction between two principal to principal basis. He is an intermediary who earns his money through commission or by whatever name called. Under section 13 of the CIGST Act 2017, the transactions covered are only where a supplier of service or a recipient of service, either of them is located outside India and either of them is located in India. 13 subsection 8 particularly covers the provision of determining place of supply, where the deeming fiction says that the location of supplier will be considered to be the place of supply. Under the intermediary service category, currently what the scenario is, if the intermediary is located in India, if his customer who is paying him commission is located outside India, the place of supply in such case is location of supplier of service, that is India. That is, intermediary was liable to pay the GST on these transactions even when his customers were located outside India, even when he was receiving the entire remittance in foreign convertible currency, still he was bound to pay the tax. Of course, it was taking away money from his pocket. Currently, if the intermediary is located outside India, but a customer who is paying the commission is located in India, then the place of supply currently is outside India because of location of supplier of service being outside India, and thus there were no tax implications on the person availing such intermediary services in India, because technically it did not qualify to be an import of service. Now friends, based on the proposed amendment, what really happens? If the location of supply, now what it says is that the intermediary services will be taken away from 13.8. The intermediary services will now be dealt with as per 13 subsection 2, whereby if the location of recipient is outside India, place of supply would be outside India. So if now the intermediary is located in India, the location of recipient is outside India, the place of supply as per the proposed provision will be the location of recipient, that is outside India. So this service will be nothing but considered as an export of service, of course subject to fulfillment of the other criteria under section 2 subsection 6. But agar ye hua, then of course the intermediary in India definitely will be calling his services as export of service, and he will be entitled for all the benefits which are eligible for a zero rated supply or export of service. On the other hand, if the intermediary is now located outside India, the customers who are paying commission are located in India, means the Indian taxpayer is availing intermediary services from a foreign intermediary service provider. In such case, now the location of recipient becomes the place of supply, that is India will be the place of supply, And since India will be the place of supply, definitely it amounts to import of service. If it is an import of service, it will now lead to an impact on reverse charge mechanism. Tax based payment will be on the Indian person who is availing such foreign intermediary services in India. Friends, of course, once the reverse charge impact comes in, it will be making him to pay the tax under reverse charge in cash. Of course, he will be entitled for claiming the input tax credit, subject to unless there is some limitation under section 16, beg your pardon, under section 17 of the CGST Act. Friends, the intermediary scenario completely changes. It is exactly a flip from the existing provisions, and therefore once this provision becomes effective, the intermediary service gamut is going to really undergo a wild change, and this is how the change is going to be. The last provision which has been proposed as an amendment under the GST law is that the National Appellate Authority, which was currently being envisaged under 1011A and 1B, was to cover also the defined category. For the while, the existing authorities will act as the National Appellate Authority, is what the proposed provision says. And in the definition of existing authority, even the tribunal will be included. Now, friends, if it is to be believed that this is the National Appellate Tribunal, the National Appellate Authority will be the national tribunal, that is the principal bench of the tribunal. Then, of course, it moves to only one place in India, that is Delhi. Friends, if we see that the GST was already given given the responsibility of taking up the anti-profiteering cases from the NAA. Now, even if the advanced ruling National Anti-Profiteering Authority, the National Authority for Advanced Ruling is also shifted to the tribunal, of course, the scope of work or the load of work or the burden of work at the tribunal definitely goes up and up. The fact of the matter is that our tribunals are yet to start functioning, and so 8 years pendencies already looms large. Along with that, the NAA cases, and along with this the appellate cases, that will be causing some serious burden on the tribunal. In times to come, we will see what exactly happened. So friends, I hope that we were able to discuss these proposed provisions under the Goods and Services Tax laws. My sincere thanks to my team, Abhinay, my partner, and my colleague from the firm, Swanand, who helped me to compile this particular budget compilation in a short span. So friends, please feel free to reach out to us for any doubts. Thank you so much. Have a good day ahead. Jai Hind. Take care.